Hi everyone, Ryan Linsky, President and Founder of Linsky Capital. I hope you're having a great week thus far. So today I wanted to get a little more granular as to what our 25-year expertise in franchise finance can do to benefit you. So what I did was I printed out a sample loan proposal. And I want to point out that the most important thing may be at the very top. What lender is proposing? Because I know with my 50 plus lending partners, what lenders have already pre-qualified everything and spoken to the senior manager and credit department before they propose, versus what lenders have just thrown out a proposal to see if it sticks and may change the terms and conditions during the approval process. I also know the most reputable franchise lenders, the most aggressive franchise lenders to grow with you and not put a halt to any of your future plans. Beyond that, we have, of course, who's the borrower? Corporate guarantors. That's the business entities. Guarantors may be other operating entities, a management company, a real estate holding company, etc. Personal guarantors. Some of my clients have investor-backed money where PGs simply aren't available, and that's okay. I have lenders that are willing to do non-recourse deals. I also have lenders that don't seek personal guarantees for very strong tier 1 brands that have low leverage, high cash flow, and they are willing to reward you for your success and tenure, but not seeking your personal guarantee. Further, any owners who own under 20% typically don't need to guarantee loans. That's how most lenders operate. In regards to collateral, what is the collateral? Are they taking too much collateral? If you're doing a refinance and you've paid down so much of the debt with the previous lender, you may not need to tie up all the collateral again. We may be able to release some of it. Perhaps some units that have upcoming remodels that you want to keep separate and unencumbered to use as collateral for the future. Purpose of the loan. We're doing a lot of refinancing to lower your rate, lower your payment, consolidate lenders, and with it, we're coupling it with a line of credit, often a DLOC, a development line of credit. But the questions are, the line of credit, what can it be used for? What are the use of proceeds? Remodels, relocations, what is it? Most lenders in the franchise space don't offer a revolving line of credit, but you do want to know how aggressive they are and how long the line of credit is. Is it a 12-month term on the DLOC that it's open? Is it a 2-year? I have lenders that do a 3-year term on a line of credit, so you don't have to rush drawing down the money as you build stores, remodel, etc. Loan amount and origination fee. Loan amount is pretty self-explanatory. What are your needs? Again, let's not look out 12 months. Let's see what you're doing for the next 2 years, maybe even the next 3 years, and let's address your growth plans and set you up to accomplish whatever it is you want to do. In regards to fees, everyone charges fees. That's okay. Let's keep them at a minimum, and let's understand the fees that you pay, if there's transaction initiation fees, documentation fees, do they cover the lender's out-of-pocket expenses, UCC searches, etc.? Or are those on top? There's wording in every proposal that's often overlooked that I read very, very carefully to understand, will there be more costs coming? Loan amortization in term and rate. A lot of that coincides with each other. A lot of lenders will just propose on the amortization in term without getting to truly understand the client's needs. Do you prefer to have a low monthly payment to perhaps sleep better at night, and you're willing to pay more interest over time and you want a longer amortization? That's great. But some clients, especially who are very cash flow strong, prefer a lower amortization, a lower term. They want to pay down their debt fast. Also, what kind of upcoming remodel needs do you have? You don't really want a 10-year amortization. If you have a lot of remodels upcoming at some point, you want to pay down some of the debt before the remodel mandates occur. In regards to rate, is it a fixed rate? Is it a variable rate? Is it a reset rate? There's so many questions. Is there a balloon payment? Discuss the balloon payment that would be coming. A lot of lenders are doing a 10-year amortization, a 7-year term, and a balloon. We really need to understand if it's variable, what is the rate tied to? There's so many indexes out there. In regards to prepayment penalty, let's negotiate that. Local banks may not have prepayment penalties. Franchise lenders typically do. Let's negotiate it and get it down as low as possible. So God forbid you need an exit strategy, it's a reasonable price to get out of the loan. Reporting covenants and financial compliance, crucial. A lot of lenders out there say to be determined in their proposal, and then clients sign it, send in a deposit check, and they don't even know one of the most crucial parts of the transaction. What is the covenants? What is the compliance? A lot of the industry norms can also be different based upon lenders. I know lenders that do very high leverage. I know lenders that have less reporting covenants. It's less money out of your pocket, less time. In regards to proposal deposits, is it refundable? If the loan doesn't get approved, or it gets approved but with too many changes, can you get that proposal deposit back? A lot of lenders will do that, but there are some lenders, and you have to be careful, they keep your deposit no matter what. It's an earned fee for them to review the transaction. I don't think you want that. Those are the main parts of the proposal. There's many more that I'd like to discuss with you. Please call me today for free consultation, expert guidance, so we can begin a very long-term, mutually beneficial relationship. Thank you and have a great day.